Using this model to predict the S&P 500 using the Federal Reserve liquidity. So it's a very simple model. It goes long on the S&P, the SPY ETF, when it predicts that the S&P is below the fair value of where the liquidity says it should be. Okay, and so essentially that means when the blue line is below the orange line, the model is telling you to go long on the S&P. And when the blue line is above the orange line, it is telling you to be flat, have no position. So these three data points are taken directly from the Federal Reserve website every day, and this is a common notion of Fed liquidity, and we take a transformation of it so that we have this nice chart where we can visually see when our model is telling us to go long and telling us to go flat. And so this is interesting. It did very well in 2022, even though that was one of the worst years for stocks. Well, it did well, relatively speaking. It didn't do amazingly well, but it had some big drawdowns, but at least it was positive. And it's done, you can see a little bit more stats on it here. And so this updates every day. Every day we get the Fed data, these three data points. And currently we are at 601 on the S&P, and this fair value model is at 600, so it's telling you to go flat. So it is telling you not to trade today. However, now things are a little more interesting than these periods when I had forgotten about this model because there was no trade for so long. But now that we're very close with these two lines, there may be trades coming in soon. So we want to keep an eye on this, and you can check it out at generalhedge.com. You can become a member, and you will be able to see these updates for this model.